Hi, everybody. This is Gary Dean with Sentiment Timing, and this is our technical video report for Monday, June 9th, 2025. So, nothing really to go over today. We saw a lot of action up and down, but by the time the market closed, the S&P was basically even. Dow was up some, NASDAQ was up some, but as I've been talking about, IWM is the outperformer again. And one of the reasons is, you have to understand. When I was saying that when the market was at the lows, that everybody was gonna be shorting every bounce. What I didn't know, and I'm starting to pick up on this more and more, is that there's hundreds and thousands of hedge funds out there. Some of them are, 5 million, 20 million. The ones that are in your, that are managing hundreds of billions of dollars aren't really don't really fall into this category. But your smaller hedge funds, they probably are the dumbest money out there. They're dumber than retail. They're dumber than they're just always they're always just following the trend. And when the trend reverses, they're usually the last ones to pick up on it, and they will short the entire rally, which they did, and they missed this entire rally. So those are the ones that are now out of their short positions and chasing the long positions. And what you have to ask yourself is, what are they going to go after? Something that is 2% from the all-time highs, or something that is still 10% from the all-time highs? So when they put money into work, they're going to be putting it into the small caps because they're going to say, "Hey, they need catch up," and that's basically what I've been talking about. And since I've said this since last week, IWM has been outperforming every single day. Um, I had suggested in the morning notes that one of the strategies you can do is short the spiders and go along the IWM. What that works. It will work definitely, but what the way it won't work is with options. And I tried that strategy today, and the thing is that IWM gapped up. So by the time we did it, it still outperformed. But where it was, it's almost impossible to use that strategy with options unless they both open. They're at the same price, because when IWM's up 1.6% and the spiders are up 0.2%, it doesn't work that way. But I have a strategy that I'm going to throw out, and I'm also going to explain why I do believe even if this market turns down, you will make more money with the short spiders than you will lose money on the long. So the first chart I'm going to show you is this is the ES. So this is the futures, and the reason why this pattern actually is a lot clearer on this. So we have two rising wedges, bearish rising wedges. We have bearish divergences, but we also have what's called wolf waves. And the way this works is you have one. This is the bigger one. One, two, three, four, and this could be five. This could be five. Whatever it is, it's here. But the way that you measure this is you take the wave one and the wave four. So one, two, three, four. You draw your line diagonal, and this is your price target. Does it always work out? No. It's one of my favorite patterns to trade though, because for some reason they do play out a lot. Now, that's the bigger one. Now, there's also a smaller one. So here's our one, here's our two. I tried to let me do this to make it easier because I already showed you the bigger one. So I'm going to take that out so we can actually see this. So here's your smaller one. Hang on one second. Let me get rid of that too. Uh, Come on. Delete. Okay. So here's your smaller one. One, two, three, four, and five. Now, again, doesn't make a difference if it's this or that. What we're looking at is the price target, and this is looking at the ES to come in right around that 58.72, a good 130 points lower. Now, the problem with the ES is this could be done overnight and then it could bounce. But I just wanted to show you these patterns on it. So I'm going to go actually to the IWM and show you why I think that will outperform. So hang on one. Okay, so actually the first one I'm showing you is the spiders. The reason why is, remember, we have this wick that's coming down here. I said we don't know when it's going to play out, but I think eventually you're going to see this wick play out. And what this is pointing to is, remember this gap up, and this was on May 27th. And from there, it came up and it's, pulled back a little bit, but kept going. So this wick is still open. We also have this open gap. So that's this part on the spiders. Now I'm going to go to the IWM. Okay, so here's IWM. Here's that same day. This is when we had that huge gap up. Now look at this. Remember when the S&P came back a little bit? The spiders came down and already closed this gap right here. This is when they were the weakest of it. So they closed this gap, and if we go back to the spiders, we're not never even came close to closing this gap. So this is going to be the actual target that we're looking at when once this pullback starts. Let me go to a better chart. Okay, here we go. So really, that's what we're looking for is this target right here. So if we do get the pullback, this is looking for the S&P to come all the way down to 57.78, close this gap. But IWM already did that. So that's kind of my reasoning on why I would prefer going long the IWM and short spiders. And I'm going to show you a way. And again, you're going to have to manage it properly. I'm sorry, I just lost my train of thought because I had to turn the phone off. But in any case, that's one of the reasons why I like the shorting the IW. I meant shorting, going long IWM and short the spiders. So let's just go to the S&P and check out what's going. All right, so here you can see on the S&P, we had a little bit. It was up some here, and then what happened was we had a little bit of a pullback here, and then we just kind of ran up. But once we ran into this resistance line, we saw selling at the end of the day. IWM, the spiders closed plus 5 points. It was nothing. So you have the IWM that closed up over, I think, over a half a point, and the spiders were up not even a 1%, no, 0.1%. But in any way, we're at one of the pivot points again. And right now, if the bears can push through it, I think we'd be coming down to the 59.78. If they lose that, then we're going to look to close this gap that was on the 5th. That's at 59.55. Again, this is the important line here because you can see we have support. They came down, they tested it. If they lose that, that's where I believe we're coming down, and we're going to be testing this gap right here that I've been showing you, and we'll come down here. So this is the important line. They obviously, if we let me just delete that. It's nothing. So if they come down, this is going to be the first line that they have to defend, the 59.19. Below that, then we're coming down and testing this support. That's going to be at the 58.60 and the 58.45. So these are your two lines in your sand. If they lose that, then we expect this gap to get closed. We have sell signals on the 15-minute chart. Does that mean that we have to, we have to go down right away? No, we need to see some support levels broke. And again, I'm not even talking like I'm bearish on this market. I'm saying let's just say I'm neutral, but I'm very cautious and do believe that we are going to get a pullback. But I'm not really pounding the table as short. And if you do short, the hedge that I'm going to show you, I think will play out pretty good. So we have sell signals on the 15-minute chart. I gave you my downside targets. If they head up, then maybe we come up to this 60.31. We'll see. But if we go to the hourly chart, again, these are pretty clear sell signals right here. We after we had this gap up on the 6, we've pretty much just gone sideways. So the bulls are tired. They need more buyers to come in. And unfortunately, right now, all these hedge funds and everybody that missed it, they're not really looking at going after the S&P that's right near their all-time highs. Instead, they're looking at IWM. But again, this is a huge bearish wedge. We have bearish divergences. When it turns, I do believe we're going to be coming down and we're going to be closing a lot of these gaps that are below it. So again, be careful. This is not screaming to short this market. And let me show you if you do short it. This is what if you're going to, this is how I would do it. So I went to my chat GPT to show a, example of what I would do. So this is right here. Which one? XPXU. So this is a 3-time short for the S&P 500. this is a 5-day chart. So let's just say on June 3rd, you decided to go long SPXU. You got in at 1936. It is at the lows. It was 1850. So what is that? Maybe a 8%, not even a 5% drop. Now, if you go and you take the 3-time long for IWM, which is URTI, got long at 33.85, and you're at 38.52. So that right there is almost a, what's it, 15% gain. They have a 15% gain here, and let me actually do the math. Hang on one second. All right, don't hold me to my math here, but basically, if you got long, this one is XPXU, you lost about 5%. Okay, so from this 5-day period, when I started saying it was going to outperform, you lost 5%. On the URTY, if you got long at the 33.85, and from here you're up about 14%. So you're down 5% on this, but you're up 14% on this. So basically overall you're up 9% in the 5 days. That's the way you can do this kind of hedge. Now, if we get the move that we're talking about, with, where what I'm anticipating, and we see the S&P or the spiders go down to that level, you're going to see this shoot up. Let's just go to 1 month. You're probably going to see this trading. I'm even going to go more than that, and say, well, it's probably going to be trading somewhere up into the 29. So you're looking at a big move on this one, and you'll lose on this, but I don't believe it will be as much as you will make on this. So that's my strategy on this. I do believe it will work. And the good part about it is that even, if you're wrong, you're not going to lose that much. I mean, one's going to offset the other, or one's going to really move in one direction, and the other one will move down at a less the rate of change that won't be as much. So that's really a strategy I would look at. And then once you see the market, if it really is pulling back, you simply just get rid of this one. You sell it and you just ride the pro shares. But that, and then from there you can start adding options. But like I said, doing with the options, it's really hard because of the gap ups and gap downs. So I mean, it's a strategy to look at. I'll go over this in the trading room, and from there, let's see what plays out. But like I said, I think the bulls are tired right now, especially on the spiders. I think any pullbacks, so you're going to see these hedge funds and people that miss this rally that are going to start buying the small caps. And even though I don't believe that will move up as the market goes down, I do believe it's going to move down less than the spiders. So let's see what plays out tomorrow. Have a great night, and I'll talk to you guys in the morning.